As the world economy continues to develop, new platforms for investment and savings are constantly emerging. However, balancing safety and potential returns is essential when deciding where to store your funds. Fortunately, this video aims to reveal the ideal options for generating high interest in your money. First option, cash management accounts. They include check writing options, credit, and debit cards, allowing them to be more flexible in money markets. They also combine attributes identical to savings schemes, frequently offering better income rates than standard ones. Here are the key reasons why they are necessary. Flexibility. High levels of liquidity provided by CMAs enable easy access to money when needed. Contrary to regular bank accounts, CMAs frequently include capabilities like check writing rights, debit card usage, and electronic transfers, facilitating smooth transactions and prompt money availability.
If you're not familiar with cash management accounts, they are slightly different from your typical checking or savings account. And with this account, there are absolutely no fees. There are no transaction fees, no minimum deposits, no overdraft fees. If you don't already have a high-yielding cash management account, checking account, or savings account, then this may be a great option for you.
Interest rates. They generally provide better interest returns than standard savings accounts. While these rates can vary depending on the market environment and the financial establishment, these accounts tend to provide a higher yield due to the nature of the investments made by the institution. Diversification. These platforms will significantly help you diversify your investment and savings portfolios. Investing some of your monetary resources in a cash management account may mitigate the risk involved with other investments like stocks or equities. Regulatory oversight. Money market accounts are subject to regulatory oversight, ensuring financial institutions adhere to specific guidelines and maintain the necessary liquidity levels. This oversight adds an extra layer of protection for account holders. The second option, Treasury securities. They refer to debt instruments issued by the U.S. Department of the Treasury to finance the government's spending needs. They are considered safe investments due to the creditworthiness of the American government. Therefore, investing in these securities is often seen as a safe place to keep cash for the following reasons. Backed by the government. Since the U.S. Department of the Treasury offers these securities, it provides them with stable backing, creating positive faith and credit from the U.S. government.
Whatever is the most attractive. But in terms of present valuing anything, we're going to use a number, and obviously we can always buy the government bond, so that becomes the yardstick rate. It doesn't mean we want to buy government bonds. It doesn't mean we want to buy government bonds if the best thing we can find is only has a present value that's works out at 0.5% a year better than the government bond. But it's the appropriate yardstick in our view.
The United States government consistently prioritizes paying the principal and interest on Treasury securities, even in challenging economic circumstances like the previous COVID-19 financial and health crises. This backing gives them a low risk of default, making them one of the safest investment options available. Preservation of principal. Protecting the principal is especially crucial for people or organizations with unique financial objectives that depend on sustaining the monetary worth of their capital over time. For instance, retirees who rely on fixed earnings from their money will prioritize protecting the principal to preserve their wealth in retirement. Minimal credit risk. Unlike corporate bonds or other forms of debt, Treasury securities are not subject to the credit risk associated with the financial health of a specific company or institution. This lack of credit risk contributes to their safety as a cash storage option. Maturities. Treasury securities come in various maturities, ranging from as short as a few days to as long as 30 years. It allows investors to choose the maturity that aligns with their cash management needs and investment goals. Competitive interest rates. While Treasury securities are generally considered safe, they offer competitive interest rates compared to low-risk options like savings accounts. This feature makes them attractive for investors seeking safety and a reasonable return on their cash holdings. Diversification. These securities are frequently used as a technique for portfolio diversification. It is because their minimal association with other asset types, like equities or corporate bonds, aids in lowering their total portfolio risk while boosting their stability during chaotic market situations. Accessibility and ease of investment. Investing in these securities is relatively straightforward and accessible to individual investors, financial institutions, and foreign governments. They can be purchased directly from the U.S. Department of the Treasury through its online platform or from brokers and financial institutions. Third option, deposit certificates. They are time deposits that typically offer higher interest rates than regular cash savings accounts. They require you to deposit a fixed sum for a specific period, ranging from a few months to several years. However, it's essential to remember that you can only access your money once the arrangement matures. Here are some reasons why CDs are considered valuable. Fixed interest rates. They offer a fixed interest rate for a specific period, ranging from a few months to several years. It means you know exactly how much interest you will earn during the prescribed term. This stability can be beneficial for individuals who prefer predictable returns on their savings. For those seeking a low-risk investment option, bonds may not offer high returns like riskier stocks and mutual funds do. However, they enhance stability and a guaranteed return, which makes them attractive for those seeking security in their investments. Financial objectives. They can be helpful for specific financial goals with a defined time horizon. For example, if you're saving for a down payment on a house in 3 years, you can invest in a 3-year CD, knowing that your money will be available when you need it, along with accrued interest. Laddering strategy. Some individuals use a CD laddering strategy to maximize their returns while maintaining liquidity. It involves spreading investments across multiple options with varying terms, such as a 1-year, 2-year, and 3-year CD. As each portfolio matures, you can reinvest or access the funds without locking in all your money for an extended period. The fourth option, online banks. These facilities have become increasingly popular as safe places to keep cash and earn a high interest rate. Here are some key reasons why online banks are essential in this regard. Security. They employ advanced security measures to protect your funds. They use encryption protocols and multi-factor authentication to ensure your accounts and transaction safety. Additionally, reputable online banks are regulated and insured, providing financial protection for deposits. Convenience and accessibility. They offer the convenience of 24/7 access to your accounts from anywhere with an internet connection. You can manage your funds, make transactions, and view your balance and transaction history anytime. This accessibility makes them an appealing option for many people. Higher interest rates. One of the main advantages of online banks is that they often provide more excellent return rates than the standard ones. They also have lower overhead costs as they don't have physical branches, allowing them to pass on the profit to their customers through better income rates. Fee structures. They typically have lower fees compared to traditional banks. It can be especially beneficial if you're looking to maximize your savings or avoid unnecessary expenses. They typically offer fee-free or reduced fee accounts, saving you money on monthly maintenance fees, ATM fees, or other standard banking charges. Innovative features and tools. They often provide innovative features and tools to enhance your banking experience. These may include budgeting and expense tracking tools, mobile banking apps with built-in financial management features, and customizable alerts. These features empower you to have more control over your finances and make informed decisions. Integration with digital services. They are well integrated with various digital services, such as online payment platforms, digital wallets, and money management apps. This integration makes it easier to streamline your financial activities and seamlessly transfer funds between different accounts or platforms. Competitive banking landscape. The rise of online banks has introduced more competition into the banking industry. This competition has led to improved services, better customer support, and more favorable consumer terms and conditions. Having a variety of online banks available allows you to select the one that best meets your specific needs and preferences. The fifth option, money market mutual funds. They invest in short-term, low-risk securities such as government bonds and treasury bills. While not FDIC insured, they are regulated and generally considered safe. Money market funds aim to maintain a stable net asset value, NAV, of $1 per share, making them a relatively secure option. Here are some reasons why MMMFs are widely regarded as secure options in this context. Liquidity. They offer high liquidity, meaning you can easily convert your shares into cash. Most allow investors to make unlimited check writing and electronic transfer transactions, providing quick access to funds when needed. Diversification. They typically involve investing in a diversified portfolio of short-term securities, which helps one mitigate their financial or investment risk. By spreading investments across different issuers, industries, and maturities, they aim to minimize the impact of any single security default or market fluctuations. Potential for higher yields. While MMMFs aim to provide stability, they also offer the potential for higher yields compared to traditional savings accounts. The interest rates on MMMFs depend on the prevailing market conditions, such as short-term interest rates set by central banks. Therefore, MMMFs can offer more competitive yields when interest rates are higher. Professional management. They are managed by experienced professionals who monitor market conditions, select appropriate securities, and actively manage the fund's portfolio. Their expertise and research will enable you to discover suitable investments, ensuring your fund are put to profitable use or maintain their investment value, safety, and stability objectives. The sixth option, high-yield savings accounts. It typically offers a higher interest rate than a traditional one. The significant interest rate allows individuals to earn more money on their savings, making it an attractive option for those looking to grow their savings over time. Let's take a closer look at 5 key points highlighting their importance and why you should highly consider this option. Higher interest rates. These accounts offer significantly higher interest rates compared to regular ones. It means that the money you deposit in this account has the potential to grow at a faster rate, allowing you to earn more interest over time. Safety and security. Reputable financial institutions, including banks and online financial platforms, typically offer the services of these accounts. Notably, these institutions are often insured by the Federal Deposit Insurance Corporation, FDIC, in the United States or equivalent entity in other countries. FDIC insurance protects depositors up to a certain amount, typically $250,000 per depositor per insured bank, ensuring that your finances are safe even if the bank were to experience financial difficulties. Liquidity and accessibility. Unlike other options like CDs or long-term investments, you can typically withdraw money from this account without any penalties or restrictions. It makes it a convenient option for keeping emergency funds or savings you may need to access quickly. Low risk. They are low-risk investments since they are not subject to market volatility. Unlike bonds, stocks, or other investments, the value of your savings in this account will not fluctuate based on market conditions. Therefore, your principal amount is generally secure, and you can expect a stable return on your investment through the interest earned. Financial planning and savings objectives. They are valuable tools for achieving short-term savings objectives, such as saving for a vacation, a down payment on a house, or a contingency emergency fund. The significant interest rates allow your funds to grow faster, helping you reach your goals more quickly. Keeping your cash in a high-yield savings account makes it easily accessible while earning a competitive return. Lastly, while these strategies generally offer relatively safe ways to keep cash with higher returns, conducting thorough research and considering your risk capacity before making any decisions is essential. Consulting with a financial advisor can also provide personalized guidance based on your monetary situation and goals. For more informative content to enable you to make wise financial decisions and investments, subscribe to my channel to access all my videos and hit the notification bell to be alerted as soon as I upload another valuable video.